Are you ready to turn your investments into retirement income? Listen in as Jeremy Keil and his guests reveal ways you can make smarter retirement, investment, and tax planning decisions to achieve your ideal retirement. You will learn more about your money so you can feel better about your money and make better money decisions. Now, on to the show.
Welcome to Retirement Revealed. I'm your host, Jeremy Keil. We're here to turn your retirement savings into a consistent income. And we are joined today by another fellow podcaster, Matt Franklin with the Rogue Retirement Lounge. Matt, how you doing?
I'm doing great. Jeremy, how are you doing?
I'm doing very well. We got connected through the podcasting community, and I thought you had a great story, a great way that you go about educating your listeners about retirement, and thought I'd have you on. So I'm so glad you're able to join us.
Well, I'm psyched to be here because not only am I a podcaster myself, but I am a fan of this podcast. So this is I'm a regular listener, so I'm excited to be here.
Yeah, I was so excited about that. I reached out to you and said, well, you probably don't know who I am. And you wrote back and said, I've listened to a few of your podcasts, so this is fun. And now we're even. I've listened to a few of your podcasts.
Oh, good. I hope they were okay. And also, I've poached guests from your podcast as well. So you've been very helpful for me.
Oh, that's awesome. Well, good. Well, let's get everyone acquainted with your story. There's so many different interesting parts about it, but let's just start with where you used to be someone that was traditionally invested. And I'll tell you that a lot of our clients and a lot of ways that we talk about retirement is more of what you would call traditional investing. But then you've made a couple pivots since then. Tell us a little bit about that, how maybe you're investing things right now.
Yeah, well, I was very traditional. I had my little IRAs, my SEPs, and I'm self-employed and have been for 15 years. So I was putting money into my IRAs, and then through my E-Trade account was buying stocks, and doing what a lot of the gurus say you shouldn't do, which I kind of don't disagree with, which is buying individual stocks. Some people say you can't time the market, you shouldn't buy individual stocks. Let Morningstar or Fidelity build a mutual fund or an ETF so that you can just let them do the thinking for you. But I was buying and selling stocks in my IRAs, and then about maybe 4 or 5 years ago, I started doing research on real estate because a buddy of mine bought a duplex, and I thought that's an interesting way to make money. And then in about maybe 2018, I think it was, I believed that we were in a terrible stock bubble. I thought the end is near. I was on fire. I started selling all my stocks and putting money into real estate. And then within maybe 2 years, I was completely out of the stock market and was totally in real estate that I owned or through real estate syndications. And that kind of led me to where I am today, which is being obsessed with trying to optimize my retirement and trying to optimize my IRA holdings to hopefully retire as soon as possible and have consistent long-term recurring revenue from my investments.
Yeah, well, that's great. And I love the idea that we're bringing someone on that's got perhaps a different perspective than I've presented. Normally, it's good to be well-rounded, and hope everyone's enjoying that part of it. And also, too, you had a little bit, you mentioned 4 or 5 years ago how your life changed, how you viewed investing. But a few years just before that, you had an interesting life-changing experience when you appeared on Shark Tank. Now, not too many people get to do that. What was that like?
Oh, it was a lot of fun. I mean, it was frightening. Jeremy, have you ever skydived or skydove? I
have not. I got a feeling I never will.
Okay, well, when you go skydiving, at least for me, I've done it 13 times, and when I was young and had very little fear. But skydiving is a mixture of terror, of absolute cringeworthy terror, and adrenaline. And that's what being on Shark Tank was kind of like, because it was so frightening. It was about a 2-year process for us to get on there. And so just the build up and watching every episode and doing rehearsals, and it just made it so that it was just such a huge event. The fear factor was amazing. And then you add into that my partner and I were a little bit hungover. You add to that the fact that we're terrible business people. You mix all that together, and it was a terrifying experience.
Well, you had a good enough idea to get on there, and I think you made some money off of it. How did it work out?
it actually worked out quite well, stupidly well at first. So the first year after the show, a lot of money came in. And yeah, so, but with that money, and when I tell people that a lot of money came in, I definitely don't say that to brag, because it wasn't like life changing, like millions of dollars, but it was enough that it was like crazy to me. And I had a bank account balance that I had never seen before. And then what I went ahead and did is I went to Europe like every year. I would go to I was going to Europe every year and spending gobs of money on travel and stupid stuff, like just incredibly stupid stuff. And that irresponsibility that I demonstrated, it hit home right around that time when I was learning about real estate. And I realized, wait a minute, I'm never going to be able to retire. I got to do something. I just spent a whole bunch of money that I should have invested. And so it was a really good lesson, because a lot of money came in, but a lot of money went out.
Yep. Well, it's amazing. It's interesting. There's actually a lady, she calls it the Sudden Money Institute, where it's different if you earn your money steadily over time, but there just might be a situation like yours, going on Shark Tank and having a big payday with the revenue that was coming in from your product there, or somebody wins the lottery or inheritance. And it's just a different feeling, a different approach. It seems like you just lived it exactly how she would describe, where when it just comes in almost all at once, it's a different experience than when it's built up over time. And now you're doing that. You're building it up over time by going out with the different real estate ventures that you have on there. So that's awesome. Thanks for sharing that. Do you care to share the company? Are you still associated with that at all?
Oh yeah. It's I mean, it's going to be gone soon. It's called, the product is called Posture Now. It's really stupid. It's a posture correction device. I mean, it does work, and we've sold tens of, I mean, how many thousands? I think last time we checked, I think we sold like 70,000 units. So it's helped a lot of people. But it's stupidly simple. I mean, we literally designed it using. We met in Chicago. My business partner is from New York. And I'm from Portland. So we met in Chicago, drank a bunch of beers, had elastic and Velcro, and invented this goofy posture corrector over the course of a weekend. So yeah, it still exists. Supply chain issues are probably going to make it so that it's not going to be worth it to keep going. But yeah, we still sell them every day, and they're every once in a while, like we re-aired on CNBC. Our episode re-aired a couple of weeks ago, and all of a sudden my email box was just pounding full of orders. So yeah, it's still kind of a thing, but probably won't be for much longer.
Well, it's helping people out, and someone had to think of it at the time. Good thing it was you.
That's right.
Yep. Awesome. Well, let's talk more about real estate investing. And you're a fellow podcaster. You talk about retirement and money. I imagine you're getting emails and pitches all the time of, hey, let me on your show. Let me tell you about this real estate thing or whatever investment. And I ignore 95% of them, probably more than 95% of them. And what I love having you coming on here is that you're a real estate investor. You're using your own money to go about learning the market. And you're not trying to pitch anything to us, like buy this product or invest with you at all. So we get like on the ground level of here's somebody that's interested in how they got into it and things like that. You talked about you got interested looking more for the cash flow, getting out of the stock market. But tell me, what do you like about investing in real estate?
Well, the number one thing about real estate is something that my dad told me when I was a kid, which it wasn't an original thought, but he told me this when I was a kid, and I didn't really realize it, or I didn't absorb it until recently. And that was that they're not making any more land. Okay. And so the finite nature, I mean, yes, you can buy shares of stock, and yes, they might be finite, but you can do splits, and you can do buybacks, or you can issue more stock. I mean, land it literally is a finite resource, and so therefore, it is my opinion that it has to continue to appreciate. There's no way that it can't. The population is growing, and so just on a very fundamental level, that's why I love real estate. Is just that finite nature of it.
Well, it makes a lot of sense. I hear that all the time too. Exactly that. They're not making any more land, and that's what gets people interested in real estate. And I imagine you started out, like you said, your buddy started with a duplex. I imagine maybe you did yourself. What are some things that you don't like about real estate?
Oh, okay. There's no perfect investment, and real estate is definitely not perfect. I had a bad tenant in a house I have in Detroit, Michigan, and he trashed the place when he moved out, and he didn't pay his last 2 months of rent. Well, that is a terrible feeling. And that kind of, because I had pretty good luck in the first few years, that kind of set me, took me for a loop, kind of, because, like, wait a minute, if I'm going to be depending on the cash flow from rentals and a renter decides not to pay, or if we have another pandemic and somehow a tenant decides that it's optional to pay and I can't get them out of the house, what am I going to do? So that, I mean, there are lots of things that you can do. You can have lots of reserves on hand, which I do. And I definitely recommend that if you do buy single family homes, that you have at least $5,000 or $10,000 in reserve for each of those homes. But yeah, so that's one thing that I don't like, is the fact that it's not guaranteed income. Okay. There are guaranteed income investments, as you well know. You can buy annuities and the like that are quote unquote guaranteed income, and rental income is not guaranteed income. So that's really what I don't like about owning real estate under your own name, where you are essentially the landlord, is just that lack of a guarantee, if you will. And then, of course, the expenses that go with having bad tenants, and the expenses that come with every house is going to end up having some kind of problem, whether it's replacing the roof, whether it's replacing the furnace. There are going to be expenses at some point, and that's another thing that I kind of don't like about it.
What you just shared, I hear that all the time. You've got a good number of people that they want to figure out how to get cash flow from real estate, and they look at the value of the house, and they figure out the rental part of it, and they say, hey, this is going to make whatever percent, and then they go into it, and then all of a sudden it doesn't make that percent when the tenant doesn't pay, or they can't find the next tenant, or they have more expenses that they expected. I kind of say it works well until it doesn't, and that's what people are telling us. And we've got a good number of clients. I think it's somewhat of almost a typical thing where you start building up, and you get to a point where you think, I want to see how real estate works. And interesting thing, it's almost like when you dabble in it, you have less of a result than when you try to get more professional with it. And I think it's just that nature of rent's not guaranteed. So if you have just one unit and all of a sudden the rent's not coming in, that's a big deal. But if you have multiple units and one of the units isn't paying rent for whatever reason, or you can't find another tenant to get in there, that's less of a big deal. And that's probably what led you to, I think, where you were talking about these syndications. And that's something that's one thing that people are pitching to me, saying, let me get on the show, talk about syndications. But you're somebody that's a part of it. What does that word even mean? What is a syndication? That seems to be like the next level up beyond, okay, I just buy a duplex on my own.
Right. Yeah. So a syndication is basically an investment pool. It's basically a bunch of people getting together, and you have a syndicator, so like a person or persons or company who is the leader. They form an LLC, and then they basically try to find investors to put in enough money so that they can put a down payment and get a loan for like an apartment building, or it could be a storage unit, or it could be a mobile home park. But basically, it's when these syndicators, when they don't have enough money to do the investment themselves, they find other investors, and then they pool their assets. And so I'm involved in a few syndications where I in a couple apartment buildings in Colorado and Tennessee. Now, I have a part of a storage unit in historic downtown Dayton, Ohio. And now those are beautiful because they are truly passive income. When the tenants at those apartment buildings clog their toilets, I don't even hear about it. So I really enjoy those. The returns aren't as great, but they are really good. In fact, I just exited one syndication that I was only in it for about 2 years, but it returned a 23-point-something% annual return, which compared to the parabolic stock market that we've seen in the last couple of years, that's not great, but that's pretty awesome for a return.
Yeah, I can imagine why you're happy with that one. Hey, sorry for the interruption. It's Jeremy Keil here, and I know you're listening to the Retirement Reveal podcast because you want to learn more about making great retirement decisions. I've created a free video course for you to do just that. head over to 5stepretirementplan.com and sign up to receive this video training right in your email inbox. We broke down our 5-step retirement plan into bite-sized videos so you can get started on the retirement, investment, and tax planning you need to create a consistent retirement income. Go to 5stepretirementplan.com, use the number or spell it out. You'll get there either way. 5stepretirementplan.com. Thanks for listening, and now for the rest of the show. And it's interesting. I'm glad you're talking about this idea of syndications, because I find that people go into owning real estate and they don't quite get the returns they project, because usually they just project out when everything's going well and not necessarily when things aren't going well. Or even then, like you call the syndications the passive income. Well, if you are maybe making great returns on your own personal real estate, well, how much of that great return is because you didn't pay someone else to go fix all the stuff? You're just doing it yourself for free, and you're just basically trading your time for some money there. And maybe it's actually not as great of a return because you're putting in the time part of it, and yet you're not counting that time part. You're only counting the money that comes back in on there.
All of my houses are out of state, so I don't really spend that much time of my own time dealing with them. So I don't have that loss to my lifestyle. I know plenty of landlords who do spend a lot of time doing those repairs. And I think you're right. They fail to take into account the value of their own time. And that's a huge deal. Especially the older that we get, we start to realize, hey, time is precious. And so if you're spending time fixing door jambs and windows at your rental properties, that's time that you're not spending with your family. And there really isn't a line item on your balance sheets when you're doing your P&Ls for your rental houses for how much time you spent. And so I think that, Jeremy, you make a very important point there.
Yeah. Well, and then interesting part of your time now, you're taking some of your time and you started a retirement podcast. Now,
yes.
A lot of people probably understand why I started a retirement podcast. That is my passion, my career. That's what I love helping people out with. Why did you start a retirement-focused podcast?
Well, I started it. It's not my career, but it's my passion and my focus. So I'm kind of like you. If we were having beers, I bet we could talk for 8 hours straight without a break because I'm so into it. So what really made me decide to do the podcast was that when I made the realization during the pandemic that I was going to be able to retire at 59 and a half and without having to save any more money. Because a lot of the reason that I was getting out of bed in the morning and why I was trying to get new clients and really trying to hustle was because I was trying to make enough money to fund my IRAs. And when I realized that, oh, wait a minute, I don't have to save any more money and it's going to be worked out for me. But then I continued to listen to podcasts like your podcast, and I continued to constantly be looking at the news as it relates to investment and just still obsessing about it. That's when I realized, okay, I got to have an outlet for this. And that's when I decided that I'm going to do a podcast. It's going to be about retirement planning, and it's going to be specifically for self-employed people like me.
Yeah, and I love how you have this extra twist on it, because not everyone's self-employed. I would think somewhat a small percentage of people are self-employed. What do you feel like is different for maybe someone that's employed by a corporation versus someone like yourself that's self-employed? How does retirement look different for them?
Okay, well, the main thing is because I did come from the corporate world. I worked for a big tech company and I had a normal job, and it was automatic, meaning my retirement investing was automatic. I'd get a new job. The HR lady would come in with the notebook and she'd put me down for my 401k, and I'd choose my risk assessment, and I'd say, oh, I'm young, I will take high risk. And then that was it. And that was all I had to do. And the money was being taken out of my paycheck, and the company matched it. And then I'd get stock options, and life was grand. So that's the big difference is when I started working for myself, all of a sudden, it's like, wait a minute, I'm not saving automatically like I was. And a lot of self-employed people that I talk to have the same thing, where it's like they stop working and they stop saving for their retirement. And it's very dangerous because a lot of people will say, okay, I'll start in my second year or my third year. When I start my business, I don't have the time or money to deal with it. And that is a very dangerous phenomenon. And so I encourage people that they need to be very hands-on about their saving and about their retirement planning from the moment they quit their job and start their business.
Well, yeah, if you're self-employed, you've got more responsibility on your own for your own retirement. And it's interesting you said automatic. I believe you've listened to or read books by David Bach, who talks about being the automatic millionaire. And it's true. It's automatic if you're just putting money in every single paycheck and they're matching you perhaps. And it doesn't have to be automatic when you're self-employed. It's almost like, hey, if you can replicate a little bit of that, that's going to be a big help for you when you make that switch to becoming self-employed.
Absolutely. And then there's also the excuses that we self-employed people use because, and I've talked to a lot of self-employed people and overall they're really bad about retirement savings. But one of the main excuses is that, at least for a lot of business or a lot of businesses, the cash flow can be feast or famine. Like sometimes you'll have 20 grand in the bank. Sometimes you'll have 50. Sometimes you'll have $150 in the bank. And that makes it hard or impossible for a lot of us to do those automatic, what you might call paycheck deductions, just because that variable nature of your income.
It just shows maybe the value of having periodic income coming in, which is probably why you were attracted to real estate. That's why a lot of times when we're helping people create their retirement income plans, and all of a sudden they're realizing they have to take money out of their accounts, and they'll say, I'll call up and I'll need money I'll take money out when I need it. I say, oh no, if you could just set this money to come out automatically to you and try to replicate your paycheck like you were when you were working, you'll probably feel a lot better than that. And here you are on the reverse side of it. When the paycheck's gone, all of a sudden there's some extra added risk and responsibility for actually saving for your retirement.
Absolutely. And awesome. By the way, I think that's really smart. Just the idea of when you are retired to create that paycheck mentality, because I think a lot of people don't think in those terms, and they do think, some months I'll need this, some months I'll need that, I'll just take it out. I think that's a dangerous trap, because at the end of the year, you might find out you took out a lot more than you should have. And so, I think that's a really valuable piece of advice, just to plan on that continual income and have it be a fixed amount.
Yeah, definitely. Well, good. Well, appreciate you coming on the show, Matt. We've talked about so many different things. Love your story there, how you came into a bit of money, but then somewhat blew it right away. I'm sure you had fun. But that led you into the next level of here is how you're going to go approach retirement investing with becoming your own real estate investor and learning all about that. And I love how you're making use of your retirement podcast. So for everyone listening, it's the Rogue Retirement Lounge with Matt Franklin. We're going to link to the show notes, have that link to your podcast on there. If you're interested in listening to someone that's kind of living it, they're in the same shoes as you are. And I just love how a lot of your themes are just kind of what's on your mind for the week. And it's definitely a lot more free form of, hey, this is what I'm seeing in the news. Here's what I'm thinking. You get it out there right away when there's news stories that are coming on. And you're just processing how you're feeling about this and then learning and exploring and then sharing that with other people. So that's just a great approach for just, here, I'm going through it. A lot of other people are going through it. Let's go through it together.
Yeah, it's a lot of fun. It's definitely a lot of fun.
Wonderful. Well, Matt, we want to thank you so much for coming on the show. I'm looking forward to being on your show. We'll be recording that pretty soon, so we'll make sure to link to that one as well. And I want to thank everyone for listening to the Retirement Revealed podcast. We believe if you know more about your money, you will feel better about your money, and you will make better money decisions.
Thank you for listening to the Retirement Revealed podcast. Click on the subscribe button below to be notified when new episodes become available. Visit retirement-revealed.com to learn more. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Keil Financial Partners. Keil Financial Partners does not provide legal, accounting, or tax advice. Consult your attorney or tax professional. Representatives have general knowledge of the Social Security tenets. For complete details on your situation, contact the Social Security Administration. Keil Financial Partners is a part of the Thrivent Advisor Network, a registered investment advisor. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.